How's it going, guys? Happy Sunday. I hope you guys are tracking your stats and working on stuff related to trading, staying engaged, looking at charts, whatever you're doing. What I wanted to do is a quick video on debit spreads for you guys so you can start applying them, and be a bit more knowledgeable about what you're doing with these things, because I know some of you guys are probably already trading them because they're requiring less of buying power, but I hope I give you guys some information that can help you assess where to place those trades and why you would want to place them there. So debit spread, for those who don't know, is comprised out of two options, a long option and a short option. So the long option is usually the basic thing, right? If you want the stock to go down, you buy an option, or if the stock goes up, you buy a call, right? So what you can do though to reduce how much you pay for this, you have to pay quite a lot of money here. You can sell a short option against it, you short an option against it, which now allows you to take in the credit for that option, and you pay way less debit for this. But of course, also you will limit your profitability. When you look at this, the max profit that you can make, it's calculating it well here for us, right? So max profit is 57 suddenly, instead of if we delete this leg, instead of if the stock goes to 0, which I don't think it's going to do. But that's just one of the main principles in options trading that you guys want to keep in mind, is that a high possible profit always comes with a low probability of happening. That's just how this goes, and vice versa. A low possible profit always comes with a high probability, right? So that's always the trade-offs that you have to think about, and think about what you want to do. One thing that we of course do is we don't just go with the statistics here, but we add other factors, certain indicators or support and resistance that increase our edge a little bit. But basically, just probability wise, that's just the trade-off that we want to do, that we are going to have. So how do we, if we don't have this, how would we calculate our max loss? It's simple. The max loss is what you pay. This can't go below 0, right? So whatever you pay is the max loss. So max loss is the debit paid. That's something to keep in mind. Then what the max profit is usually, no, it's not usually, that's how it's calculated, is spread width minus what you paid. That is the max profit. That's the next thing to keep in mind. So because when you look at I think I have a curve here, because of this option, right? What this option does is we sell it. So what we want for this option to do is to with the stock price to be above this option, so it keeps losing value and ends up worthless, right? Because this option's value we want to go down, and this option we want to go up, so we want the stock to go up, down, in its direction, right? So because of these two, as soon as the stock goes below this strike price, this one starts working against this one. So that's why the profitability here is limited, right? Or the possible profit is limited. But say I draw this out a little bit, suddenly we are changing the dynamic of this spread, where suddenly the max profit goes up into the 190s and the max loss is 113. So let's say we are gonna go, that's about a 2-to-1, right? Like max profit is 330 and max loss is 170. That's in the ballpark of a 2-to-1, right? So, but what you want to think of now is that like the probability of this actually happening is quite low. Like the probability of the Qs going all the way down at below 197, as you see with the delta here, is like 34%. So you are here we go again, like it's a higher possible profit, but the probability is just going down because the stock has to go further until it reaches that max profit. So that's kind of how you want to think of this. So say, like what I sometimes do, or so, I mean, I rarely do that, to be honest. Let's say I have like a $2 wide spread, and I'm thinking of, like a technical factor or something like that. 1 second. I have to sneeze, I'm sorry. All right, here we go. So what I do like sometimes is, like you can do something like this, where suddenly the max profit and the max loss are really like going a lot in our favor by, just moving this a certain way, that we are suddenly getting like, like a really nice high win rate. But you also want to see that just the probability of the stock just going down here is only 37% statistically. Like, the reason why I would do something like this is if I have like on the chart like a resistance or something, or an indicator like say the Celts that we work with, that would help me with this decision, so that I can justify losing that much to perhaps make that much or somewhere in the ballpark. But the next thing that you also want to be able to calculate with this is the break even, because the stock doesn't just have to go down to 198 for this to suddenly become profitable, because I've paid a debit for this. So with time decay, this is like gonna slowly eat into where this this spread is going to get profitable, and the break even for this, like at the expiration, that's where the stock has to end up to just break even on this spread, is calculated by taking the long strike and you add the debit paid to it plus debit paid, or like with a put spread, it's minus, right? It's just in the direction that you go. So with 198, sorry, 198, and we want it to go down, so it's we subtract that. We subtract the debit that I'm paying for this is 0.73. So that would have to go to 197, 197.27. So that's the break even, and suddenly like it gets even harder, because 197.27, that's almost like a probably 35% probability. So with spreads like this, what I always want to keep in mind is that this basic principle, it's so important that you guys want to keep that in mind whenever you look at this stuff, is that for a high possible profit, you're always going to get a low probability of happening. That's just how it is. That's just the law of probabilities. So we can also look at this on the other end. So like say I'm going to get like this $3 wide spread, and I'm paying $2 for it. So now I'm risking say 2 R's to make 1. Again, I'm risking way more, but I have a very high probability of this happening. So like it's a low possible profit, right? Like I'm risking I'm risking 2 R's to make 1 R. Low possible profit, but the probability is like the probability of this option being in the money, 66 delta is 66%, right? So that's always what you want to keep in mind. So yeah, I think that's the basics of spreads. If you have any questions about this, please let me know. I think I might just do like a credit spread video next, so you guys see the difference. But yeah, let me know if you have questions, and I'll see you guys in chat.